Welcome to the Deep Dive, where we take the research you provide and turn it into the knowledge you need to make smart moves. Today, we are strapping in for a deep, hyper-local dive. We're really drilling down on the 2026 real estate forecast for Essex County, New Jersey. And we're not talking single-family homes. We are focusing squarely on the multifamily investment market. So if you're a first-time multifamily buyer, maybe looking to house hack your way into wealth, or you're a long-term local investor, or even a small landlord thinking about selling, you've been getting hit with all these headlines about economic uncertainty. I mean, you've probably heard talk of a crash, a rebound, a recession. Our mission today is to cut through all that national noise using the dedicated sources you sent us and figure out if 2026 is truly going to be this reset year that everyone's whispering about, especially in places like Newark and East Orange.
And that tone in the sources, that no BS guide approach, is so critical here. It confirms that the word reset, well, it doesn't mean a crash. It means a return to strategy. We're finally moving away from those, those chaotic years.
The frenzy.
Exactly. The frenzy of high prices and near zero rates that, frankly, created an unsustainable market. And now we're moving back towards something that looks, normal, balanced. For you, the listener, that means you can shift from making fear-based decisions to finding fact-based opportunities.
Okay, let's unpack this. Before we hit the streets of Newark and East Orange, we have to ground ourselves in the big forces at play. And those forces, surprisingly, they seem to point towards stability. So we have to start with the national picture, right? The key numbers defining this reset.
That's right. And what's fascinating is that the general consensus among major economists, it isn't predicting volatility, it's predicting predictability. 2026 is forecast as a year of slow, steady improvement for both buyers and sellers.
So not a wild rebound like 2021.
Not at all. And also not the steep price correction that, some people have been patiently or maybe painfully waiting for. Just look at the national projections for existing home sales. The forecasts are all positive, but they vary dramatically.
How dramatic?
I mean, some are forecasting a 2% rise, others are all the way up at 14%.
Wow. That's a huge spread.
It's a massive 12-point spread. It tells us that the national data is almost useless on its own. It screams, hey, the market is totally bifurcated. You have to focus on your neighborhood.
No.
But the fact that everyone predicts more transactions, that's the key takeaway. More sellers are expected to list, which is the first step toward that balance we were talking about.
And prices, crucially, prices nationally are projected to grow slowly, like 1 to 4%. That's slow growth. That feels like the true sign of stabilization. But stability isn't just about the number of homes traded. It's about the cost of money. Mortgage rates are expected to continue their gradual decline from the highs of 2024 and 2025, but the experts are adamant about one thing, right?
Oh, absolutely. The 3% days are
gone, firmly in the rearview mirror.
We really need to set a firm anchor for your planning. The source material shows that most major national forecasts, they cluster the average 30-year fixed loan in the low to mid 6% range for 2026.
So that's the new reality.
That's the new reality. It removes the uncertainty of the past few years where rates seem to jump weekly. Buyers need to realize that budgeting for, say, 6.5% is the stable, conservative approach, not, clinging to the hope of 5% again.
But wait, if prices are still going up, even slowly, and rates are anchored in the mid-sixes, aren't we just looking at a price standoff instead of stability? I mean, sellers who bought back in 2018 or 2019 still have massive embedded equity. They might be holding on to those peak pricing ideas. Where does the source material say the break will happen?
That's a great question because a true standoff would just lead to stagnation. The break happens in volume and geography. When we move to the local level, we see that sellers who must move, life changes, portfolio consolidation, or just realizing their peak price expectations are unrealistic, they'll be the ones to create the sales velocity.
Okay, so the stability is in the rate itself.
Exactly. When rates stop fluctuating wildly, buyers can commit to that 6.5% payment and say, okay, this property works at this rate, regardless of the noise. It gives buyers back their confidence, and confidence is what drives volume.
So the bottom line for the listener, nationally, is that 2026 is about having a little more room to breathe. It's not about timing the absolute market bottom. It's about being deliberate and making a strategic move that makes financial sense for you at that mid-6% payment level.
Precisely. And that deliberate stability holds especially true when we connect this to northern New Jersey. The region overall anticipates more sales activity with prices remaining fairly stable. This really benefits established commuter and job-centered markets, which, that perfectly defines Essex County. Local real estate professionals are basically calling 2026 a year of stability.
Okay, here's where it gets really fascinating, though. When we zoom in on the specific thing we care about, multifamily properties inside Essex County, our sources point out a significant split here that completely changes the investment strategy.
Yeah, the dynamic is highly complex, and it just confirms that local data is everything. Since 2021, the average sale prices for many multifamily buildings across the wider county have actually dropped sharply.
Dropped?
Dropped. Yeah, we saw a definite correction in some of the more suburban or less transit-served towns when those rates spiked.
But then you have these massive pockets of resilience. Does the source material give any specific reason why Newark and East Orange are bucking that trend? Is it just access to Penn Station and NYC commuters, or is it the sheer velocity of investment?
It's both, but the volume is the clearest signal. Newark in particular has seen average multifamily prices either hold steady or, in some cases, even rise recently. That growth is driven by ongoing large-scale redevelopment projects, job growth near the colleges and hospitals, and just sustained intense investor interest. That's the geographical advantage at play.
So Newark is the core.
Newark is the core, and East Orange is right next to it, sharing that crucial transit access.
And we know exactly where the smart money is flowing, because the data ties directly to transaction volume. Newark and East Orange together, they account for the vast majority of multifamily sales volume in the entire county.
Right.
That tells you that even if the wider county market softened from the rate shock, those core transit-served spots are still seeing heavy competition. This split creates a dual market, doesn't it? Some areas with softer prices for the persistent buyer, and then the established cores that demand a premium for stability. Let's focus first on the group that's most excited by this reset. The first-time multifamily buyer, the house hacker. The sources make a strong case that 2026 is practically built for house hacking in towns like Newark, East Orange, or Irvington. Why is the opportunity so strong right now for that specific strategy?
Well, the foundation is just this enduringly strong rental demand, and that demand isn't going anywhere fast. When you factor in the high entry prices and the still elevated mid-sixes rate environment, it just forces a larger portion of the population to rent longer.
And we're talking about a specific kind of rental here.
Yes, specifically the workforce and mid-priced rental sector, which is the exact bread and butter of the 2 to 4 family buildings in Essex County. Plus, multifamily construction, especially of the smaller kind, has really cooled off since 2023 because of financing costs.
So less new supply.
Less new supply hitting the market to absorb the demand. That keeps vacancy rates low for well-maintained existing properties.
So if you're looking to live in one unit and rent out the others, this rental market stability gives you, what, 3 key advantages. The first one is predictability, right? A well-kept, reasonably priced unit is very likely to stay occupied. What's the second advantage?
The second is opportunity, specifically with the aging housing stock. You might find better deals on older, undermanaged 2 to 4 families that were avoided when rates spiked and smaller investors pulled back.
These are the properties that need a little work.
Exactly. They often suffer from deferred maintenance, a leaky faucet, a 50-year-old kitchen, outdated cosmetic appeal. For the house hacker who's willing to put in sweat equity while living there, that deferred maintenance instantly becomes their profit center.
And the third advantage, which kind of ties everything together, is the strategic use of financing in this stabilized rate environment.
Precisely. You can lock in that mid-6% loan now, secure your property, establish your equity base, with the very clear potential to refinance later if rates drop further.
Down into the 5s, maybe, in 2027 or beyond.
Maybe. And this removes the immediate pressure to get the absolute lowest rate. It lets you focus on the property's operational health and long-term equity potential, rather than chasing some fleeting mortgage product.
That shifts the mindset entirely, doesn't it?
Yeah.
The final thought for this house hacking group, according to the sources, is to pivot. Pivot away from, can I time the absolute bottom of the market and get a 5% rate, to a much more practical question, which is, does this property cash flow reasonably based on current mid-6 rates give my family a solid place to live and set us up for long-term equity? When you answer that honestly, using local rental comps, a lot of that national market noise just kind of fades away.
Okay, so moving now to investors and contractors, the people who make a living buying, fixing, and managing property. We have to acknowledge the utter shockwave they just absorbed. The last few years were incredibly painful. The sources report that multifamily sales volume in Essex County fell, get this, more than 80% between 2021 and 2024.
80%. That's staggering. That means local real estate attorneys, title companies, contractors, they went from being completely overwhelmed to fighting for scraps. It shows the sheer shockwave that rising interest rates sent through local business.
It was a massive contraction. It signaled that many owners and investors just stepped away from the table because the math didn't work at 8% interest. But the sources are clear. 2026 is where things start to thaw.
The thaw begins.
More deals are expected to trade as rates ease and, crucially, as sellers adjust their expectations to the new mid-6% reality. They realize that the 2021 appraisal isn't coming back anytime soon.
And for investors specifically, national and local multifamily forecasts highlight some clear sweet spots for maximizing returns. We keep coming back to that middle market.
Absolutely. The research suggests that workforce and mid-tier rentals are projected to outperform high-end luxury buildings.
Which often see higher vacancy.
Higher vacancy, more tenant turnover, demand is strongest and most stable right in the middle of the market. This raises a really important strategic question for investors. How do you create value when prices aren't just crashing? The answer is through intelligent value-add plays. In Essex County, this means taking those tired 2 to 4 families and bringing them up to modern tenant standards to capture that mid-tier renter.
And what does that look like, practically speaking?
It means budgeting for things the modern renter actually demands. We're talking reliable in-unit laundry, keyless entry, better security systems, and modern durable kitchens.
Not necessarily granite countertops.
No, not granite, but solid, attractive finishes. These relatively inexpensive upgrades can dramatically boost achievable rents and tenant retention, and that's where the profit lies in a stable rate environment.
So the synthesis here is key. This market rewards the smart professional. It rewards the investor or contractor who can budget their renovations tightly and manage tenants well, without just relying on massive appreciation.
Right.
It provides better potential pricing than the peak, without the utter chaos and lack of financing that came with the highest rates. You have more time to actually think and analyze each deal. Our last audience segment is the local sellers and small landlords, the ones who've been kind of frozen in place, unsure if they should sell into what they perceive as a decline. The source explicitly says 2026 is a year to plan, not panic.
That's the necessary shift in perspective. For sellers, 2026 represents a normalization of expectations. Yes, more inventory is coming onto the market, which means buyers have more choice than in the past few years.
But normalization isn't a disaster.
Not at all. Well-prepared homes in good locations are still expected to sell at healthy numbers. The difference is just, you can't list aggressively and expect 3 cash offers above asking like it was 2021. You have to price with integrity and show the property well.
And for small landlords in the Newark, East Orange, and Irvington areas, the situation is particularly stable because of that strong rent growth we discussed. Solid tenant demand, strong rent levels. It means this is a great time to step back and honestly evaluate the property against long-term family or financial plans.
Yeah, and the source material provides clear strategic options for these landlords. They might decide to hold and refinance later when rates drop further, securing a better loan on an asset that's appreciating slowly. They might decide to execute one of those value-add plays, renovate vacant units and push rents to maximize their cash flow.
Or just get at.
Or they might decide that now is the time to sell and trade up or trade out of the landlord business entirely. But the crucial caveat is that all these decisions have to be based on real cash flow numbers specific to their building, not just scary, vague national headlines about housing crashes.
So the bottom line for any local seller is be realistic, not scared. If your home or building is priced right for this balanced environment and it shows well-meaning else, it doesn't have all that deferred maintenance an investor would demand a discount for. The house hackers and the smart investors we just talked about are still very much looking for exactly what you own. You just have to meet the market where it actually is in 2026. Okay, as we wrap up the deep dive into the Essex County 2026 reset, let's quickly recap the major key to winning in this market. It's planning early, understanding the hyperlocal Newark and East Orange data, especially that difference between the core and the wider county, and running those numbers honestly.
And that leads directly to the most actionable tip from the source material. Don't be the landlord or potential buyer who lost thousands of dollars because an instant online estimate or a generic national article guessed wrong. Seek out what the source calls a local market checkup or a comprehensive home value review. This analysis isn't automated guesswork, it's a real investigation.
Hmm.
It looks at your specific property, recent comparable sales, local rental demand, and your 12 to 24-month goals. Having that specific, grounded information is the only way to protect your family's next move.
Absolutely. The most important move you can make in 2026 is the one you decide upon, whether that's to buy, sell, renovate, or simply sit tight. When you approach the market with clear eyes and no BS, use this period of stability to your strategic advantage, and we'll catch you on the next deep dive.